on a very important topic that the CFO board is happy to create a platform for discussion. And while we have only about 60 minutes, over the 60 minutes, we'll get a good glimpse of what is possible. And of course, we'll come back with more based on your feedback. For the moment, I'd like to hand over to the chair of the session, Mr. Giridhar Sanjeevi. Over to you, Giri.
Hi, thank you, Pranjal, and welcome to all the delegates and to my colleagues on the panel. I think these are really exciting times. I think whether it's an old economy business like ours in the hotel sector, or more importantly, the new economy, we have seen so much funding that has been raised in the last few months. I think with the liquidity and with the kind of funding that companies have raised, it's just amazing actually. And bankers are very busy. And obviously in this environment, we have also seen people explore newer forms of funding, to be honest, actually. And SPACs is something which we have seen develop in the last couple of years in the US market and clearly taking a significant share of all IPOs. And in India, we have seen one company, at least Muthu from Renew, kind of do it recently. So today's discussion will be very useful for me personally. I think I must say that I know very little about SPACs actually, except to sort of watch it with interest. And I think the way we have laid out today's session is to get Vivek from KPMG to speak about what he's doing with vis-a-vis clients, because he's representing both SPACs as well as Indian companies who are wanting to list. And thereafter, we have three other interesting speakers, Muthu from Renew, who has done it, Abhay and Amit, who have considered it or are working on it, so they can give you some of their considerations. I think all these three companies were largely unlisted, and I think there are questions around, can listed companies do? What are the steps to be taken? Am I eligible if I'm thinking of a SPAC? Should I be thinking about it? Will I be eligible to do? I'm sure there's a bunch of questions in your mind. So without wasting much time, let me first pass on to Vivek for an overview. Actually, over to you, Vivek.
Thank you, Giri, and it's a pleasure to be here. A warm welcome to all of you participants. So before I turn you over to the real stuff, and Muthu, Amit, and Abhay will talk about real life experiences, let me very briefly touch upon what a SPAC is, why is it useful, what is the kind of supply side that exists today in the market, and then most importantly, the one thing that I do want to talk about is there is a bunch of conversations that are happening in the market around SPACs, but is SPAC really for you or not? So we have a 6-point feasibility test to see whether you as a founder, you as a CFO, you as a CEO should even entertain any conversation around SPAC. So I will talk to you about that 6-point feasibility test as well. So let me just bring up a small 3-slide presentation that we have. And Giri, you can tell me when it's visible.
Yeah, it is visible.
Okay, fantastic. Okay, so in terms of what is a SPAC? So SPAC is a publicly listed shell company. So what happens is a fund manager actually goes out into the public markets. It is currently a US market phenomenon, although Singapore, UK, and even our very own Gift City are threatening to start working with SPACs. Currently a US market phenomenon. So fund manager goes out really into the public markets, raises cash on the basis that within a 12 to 24 month period, he will consummate a transaction by buying an operating business. So the cash will be used to buy an operating business. And this operating business typically would merge into the SPAC entity so that cash is available for the growth of the underlying operating business. So a bunch of businesses, therefore, located all around the world can use this as a route to directly get listed in the stock markets. There is a shell company in US listed on the US exchanges, and either through a merger or a buyout and a swap, you can actually list your operating business on the stock market. So that's what SPAC is all about. In the context of India, we have norms under FEMA where direct overseas listing is currently not permitted. Because the obvious question then is, why should I even need to go to a SPAC? Why can't I just simply directly list in the US? The answer is very simple. our regulations today do not permit a US listing directly. In other words, if you're an Indian company and you want to list depository receipts or some other derivative instrument, you can access the US public markets, but you cannot list your shares directly on the on a foreign stock exchange. This is slated to change. The government publicly announced its intent last May. The revenue sector, the finance secretary actually very recently in a public interaction said that this is at last stages, and we are expecting in this year's budget the necessary changes to happen to make this a reality. But as of now, as we sit today, SPAC is really one of the core routes to go public on the stock market. Now, if I were to look at the hard data behind SPACs, it's a very interesting trend. And I get asked this question a lot. Are SPACs really for real? Is this something which is just a fad because there's so much money sloshing around in public markets? Or will we really get to see SPACs become successful and see light of day and so on and so forth? I simply point to this data. If you see the numbers from 2017 to 2021. So first of all, these 5 years have been the heaviest ever SPAC years. So pre-2017, potentially in the last 10 years, as much money would have been raised in SPACs as has been raised in 2017 alone, which was a $10 billion number. So 2017, 2018, 2019, the SPAC dollars that were raised were roughly 10 billion, 10 billion, and 14 billion. 2020 suddenly exploded, and this explosion also happened in the back half of 2020. So I don't know if COVID's got something to do with it. But 2020, you suddenly had 84 billion SPAC dollars being raised and a total of 248 SPAC sponsors, or a total of 248 SPAC vehicles being created. 2021 and the last 3 or 4 months have been very, let's say, muted from a SPAC standpoint, but still we have 440 SPACs being raised with $126 billion of SPAC capital. So if I see some of the SPACs that were raised in 2020 and the SPACs that have been raised in 2021, and then the mergers or buyouts that have been announced, our rough calculation is there is somewhere around 140 to 150 billion dollars of capital waiting to be deployed in the SPAC universe. And that explains the intensity of conversations happening in India. I get asked the SPAC question twice a week or thrice a week. I'm working actively with 12 to 14 Indian companies or SPAC sponsors on one side or the other, right now trying to assess feasibility of a SPAC transaction. The fact that there's 140 to 150 billion dollars of capital out there at play from amongst 450 SPAC sponsors, roughly about 450 SPAC sponsors, is the reason why the conversation intensity is so high. And yet, India has seen only 3 SPACs ever. So in all of India's history, despite the crazy amounts of capital that has been raised in the SPAC format in the US exchanges, waiting to be deployed in global markets, India has seen only 3 SPACs. There was one in 2015, there was one in 2016, and then there was one in 2021, the most successful and the largest of them all. So why have there been only 3 SPACs, despite the fact that there is so much of SPAC capital out there? So in our analysis, there are 6 core issues which all of you as CFOs, CEOs, founders, etc., must think through before even entertaining a SPAC conversation. I have been privy to so many hours burnt. I've been privy to so many conversations in the last 6 to 9 months where straight off the bat, we have told the sponsor or we have told the Indian company, whoever our client is, that in this kind of company structure, we don't see the SPAC as being feasible. And yet I've seen countless hours being burnt in this exercise. So the 6-point feasibility checklist for whether a SPAC can happen or not is something like this. Question 1 on the left, are founders resident in India? So no matter where your company is based, there are many companies who are today headquartered in Singapore. There are many companies who are today headquartered in India. Notwithstanding that, are your founders resident in India? If so, how will they participate? Remember, India is a capital controlled company, so it's not simple for Amit from Grofers to hold stock in a US company, which in turn then holds stock in an Indian company. That's called a round trip. So that has its own complications. For Amit to invest in stock worth $100 million overseas, he needs a route under FEMA to be able to do it. So the question one to be answered is, if founders are resident in India, how will they actually participate? There are some structures that work in this case. There are put calls. There's something called a shelf offering, which can be done, which can give promoters some liquidity or founders some liquidity. But the most important question to answer is, if founders hold substantial stake, and that substantial stake is based in India, then a SPAC is almost always very, very difficult to do. When I say substantial stake, I say if Indian resident shareholding for the founders is more than 25-30%, a SPAC is likely going to be fairly complicated. So that's gating issue one. Gating issue two, am I already externalized or will I need to externalize? By externalization, what I mean is the ultimate holding company where all the venture capitalists or the private equities that have invested, is that company housed in India or is that company actually housed overseas? If that company is housed overseas, notwithstanding the fact that my resident holding might be more than 25 or 30%, a SPAC may still be feasible. But if that company is based in India, and if the answer to question one also is that my founders are resident in India and hold more than 30% stake, a SPAC is almost going to be impossible. So these two questions really from a structural perspective are very important. If your company is externalized, i.e. headquartered in Mauritius, headquartered in Cayman, headquartered in Cyprus, headquartered in Singapore, a SPAC is almost always possible, notwithstanding your cap table. If your company is not externalized and your resident shareholding is more than 30% or 25%, a SPAC is going to be very tough. Third question that we have to answer, is there Chinese shareholding, direct or indirect, on your cap table? If there is Chinese shareholding on your cap table, remember two things. Both the Indian regulations today in the form of Press Note 3, as well as US regulations have checks to see how Chinese shareholding can be dealt with. In a SPAC transaction, it is highly likely that you will be issuing new instruments of equity or other capital to these investors. So for a number of situations, I've seen that pre-SPAC or pre-listing in the US, some bits of Chinese shareholding have had to be cleaned up through buyouts, through other mechanisms. So the third feasibility question to answer is there Chinese shareholding and will that impact feasibility? The fourth question is an equally important one. Typically, the companies going in for a SPAC are companies which are held minority by founders and majority by a bunch of private equity and venture capital investors. The question I must ask is, are my investor structures supportive? And by supportive, what I mean is, are investor structures set up in a way that a SPAC transaction is not likely to make the transaction taxable for them? Very many such situations arise. If shareholding is from Singapore and Mauritius, if shareholding is pre-2017, then it is highly likely that an investor is very flexible in terms of what kind of SPAC structures you can put in place. If that is not the case, there are only one or two structures, reverse triangular mergers and stuff, which can actually work for the investors. So question 4 of the 6, are my investor structures supportive or not? Question 5, again, a very important question, how big am I and how big do I need to be? My last SPAC conversation, which was a conversation that lasted about 15 minutes, was a conversation with a founder who today runs a 25 crore business. And he wanted to get listed at a $200 million valuation through the SPAC route. The funny part is he actually had 2 term sheets to do it. The point of the matter is, as Muthu will soon tell you, post becoming a SPAC, you're actually a normal US listed company. Now, if you're a normal US listed company with 25 crores in revenue, with huge losses and a $200 million SPAC valuation, then it is likely that you will struggle through that valuation as you go forward. So how big am I and how big do I need to be? See this from the lens of not what the SPAC sponsor is selling you, because it is in his interest that the deal happens. See this from your own lens of how you will be as a US listed company going forward, and how will you create value on the US exchanges as you go forward. The last question, is my business ready? The CEO, the founder, the CFO, are the people who will be signing off on US SEC-based regulations. From a reporting perspective, from a governance perspective, from a legal obligation perspective, and from an impact perspective, if those legal obligations are not met, the responsibilities are onerous. There are criminal liabilities in play if SEC norms are not properly complied with. So a very important part of what you do is not just get the transaction done. It is, are you ready to be a listed company subject to quarterly disclosures, subject to disclosure of all material items? And do you have the risks and processes, the accounting systems and control ready to call yourself a US listed company? So this is very quickly, our 6-point check. Of course, commercially, it makes preeminent sense if a bunch of founders, if a bunch of sponsors are chasing you and you get to ring the bell at NASDAQ and become a US listed company. But do think about these 6 points before you enter that conversation at a serious level. Thank you very much. I will be around on the panel, but for now, I will turn it back to Giri.
No, thank you, Vivek. I think that was a very useful perspective and also a cautionary perspective in terms of who can look at SPACs. I think with that, I will pass it on to Muthu, because not only he has completed, of course, a SPAC. And what will be really interesting to hear from Muthu is how we went about it, and maybe also address why we choose SPAC over other opportunities that he may have had. Over to you, Muthu.
Hi, thank you very much, Giri. Thanks actually for being here. Vivek, that was actually a very good summary. I was actually going to say, all those who are in the link, feel free to ask questions, and I guess all the panelists will take, and if you address it to anybody in particular, we'll do it, and we can do it in parallel as we actually do it. And I'll try to sort of speak for 15 minutes, and therefore we will keep this at actually a high level. Let me actually start from a completely different perspective as to why SPAC exists for the investor. Because we are so much deeply into whether we are eligible, whether we are qualified, whether we need it. I think it's also important to see whether the customer whom we are actually going to cater to meets any objective. The way I actually look at it, as the name suggests, it's actually a public investment in a private equity in nutshell, PIPE in short. I feel there may be many versions and variations of this theory as to why PIPE exists, but the way I look at it, the reason why PIPE exists is because fund managers and investors who otherwise only invest in public companies end up, as you can imagine, more like in US environment, end up being sort of not allowed to invest in early stage. They actually are deprived of an ability to invest at a high risk but a high return kind of a company. So that is why when the SPAC started, the companies who were eligible to actually be invested are mostly growth companies and emerging companies, and not emerged companies. However, we are an emerged company. I'll talk about it in a minute, and as to why actually for us it was a neutral choice between SPAC or a listing or a private equity. That is actually the first point. It meets the gap of private investment in a public company, which actually, if the investors are willing to take the risk, they are going to be eligible to get the return. And that is exactly why, if anything, let me actually say upfront, SPAC is not a shorter route to list. It's actually in a way a longer route to list, because you don't find regular listing companies put out projections. You don't find so much diligence that is happening. There is a diligence report by the SPAC company. It's like a regular M&A when it comes to deal between SPAC and the investee company, and it's like a regular listing. Plus, you give projections, and the reason why you give projections is for the same reason, that you want to put your version of the story out, and the investors choose to whether they believe or they don't believe. If they believe, they invest, and if they don't, they would like to move on. So that is the investor perspective. Now, with that in background, let's come to who is eligible. SPAC is a very old concept. It's been there for a decade or more. I don't know exactly the time. But in the beginning, for a very long period of time, as you would have observed from the data that Vivek showed, it was more for companies which are very early stage. So in some sense, for the company who's doing SPAC, it is, and when I say SPAC, more or less, I mean the operating company. Okay, generally the SPAC is referred to as the special purpose company, the sponsor, but here I'm referring to the investee, which is the ultimate surviving currently operating company. Now, from company's point of view, actually, you can raise money either through private equity or through public equity. And when you actually are considering SPAC, that means you're ready for listing. That's the bottom line. You would like to list at some point in time, and why not now? That is the real answer. So the question is, are you ready to list? And that too, if you choose US market, which is where most of the SPAC is, although you can do theoretically SPAC in other places, but most of them are in US, you are subject to the caution that Vivek actually put out, which is, you're going to be governed by US governance. That's not pretty easy. They are not prescriptive. You need to, it's high cost. It's meant on principles rather than actually bright line tests, more of them. So therefore, are you ready for governance? So if you're ready for governance, you go ahead. And number two is structure. I can speak for hours on structure. Vivek touched on a couple of topics. Believe me, please take a lot of advice on, sort of structure. It's not impossible. I'm not scaring you, but there are a lot of details in it. That's the limited point I would like to say. I'm happy to actually take questions if there are any, but, let me move on quickly because I can, sort of spend hours on this. The first consideration is whether your business is ready. Second consideration is whether you are wanting to list. And, third consideration is whether it is an appropriate route compared to other options that you will have on the table. And the next consideration is the structure. And the next consideration, I would say, is actually the cost. Now, it's probably the highest cost transaction I've ever come across, whether it is M&A or it is early stage, humongous amount of raising costs. You pay banker's fee, you pay SPAC sponsor fee, it's all non-cash, and it's all value, it's all cost for you, and it's all value for the other side. So it's a completely regular listing. So therefore, you spend all the cost that is required for a US listing. So it's the highest cost transaction. It's very, very high cost. It can be anywhere between 50 to 20% of the capital raised, depending on the size of the capital that you raise. Slightly dynamic. It also depends on how much pipe you raise. So some costs are fixed and some costs are variable. So fixed cost can be absorbed, over larger pipe if you happen to get larger pipe. Let me also say one other thing before actually we move forward. Basically, currently SPAC went through a big spike, and in the last few months or couple of quarters, it is also going through testing times. So therefore, I would think this is very typical of any US market where there are cycles, ups and downs. You hardly find, any product which is going to disappear, come up to this level of existence. It's been there for a very long period of time. I think it will morph into some things, but, my feeling is actually it's there. You just need to find suitability of SPAC, for you. Now, coming to Renew, actually, I'll say that we were actually down the path of doing a regular listing in US. Basically, because we are a decade-old company, we are already, sort of $6 billion capital invested, another $4 billion committed. So we are a $10 billion capital invested company with $1.5 billion to $2 billion of actually equity at various stages of commitment. And we are already an EBITDA. It's a capital intensive business. So our EBITDA is very high in terms of proportion, but still we were actually going to be $800 million of EBITDA. So we were all set to actually go for a regular listing. The reason why we did SPAC is because as we worked on various alternatives, now of course, like a typical, sort of a businessman, you will consider all options on the table. SPAC is one, listing is another, private equity is third, strategic is fourth. The whole world is actually, is filled with options. So we were looking at various options, and when we were very seriously considering listing, SPAC came by our way, and the partners that we identified, frankly, we didn't do too much beauty parade. We did beauty parade for, competitive tension and price realization, etc. Basically, because we needed to find the kind of a partner who will come and slot, together with us, and together we'll be a big force rather than individually. Given the history of our company and long history of our company and successful foray into various parts of the renewable energy, we needed to find some sponsor who will also add real value to such large company. So the partner that we chose was highly respected on various counts, on business knowledge, on geography knowledge, on financial markets knowledge. They were going to be able to raise, we eventually did $1.2 billion transaction, which is a proof of the pudding. So therefore, it's extremely important that you choose the right partner. Sometimes it's price just the criteria. And if you take that as a criteria, then obviously, you do a typical competitive auction process. But for us, it's slightly more than that. So therefore, we went through that process. And like I mentioned, we could have actually done the regular listing. For us, SPAC is actually as real an alternative as actually a regular listing was. And very rarely you will find this thing possible. I mean, company who does SPAC, is probably going to be unlikely to be eligible for a direct listing because they've not reached the maturity level of the business. And the reason why you have a SPAC, like I said, early investment, but in addition to the checks of projections and diligence, the important check in the product is also the fact that SPAC sponsor is a very, very reputed businessman or group of them. So the fact that they're giving a stamp of approval to the company that they are merging with is by itself an extremely important validation to the transaction. And how much sort of important it is if, let's say, a global operating head of energy company trying to give a stamp of approval for another company. So obviously their own brand value comes into play, and their own responsibility has to be demonstrated. And that these are the three things why actually SPAC is a proven concept, and it's been there for a sort of a long period of time. We spent enormous amount of time on structuring. We were eligible on all the criteria that Vivek laid out, but still the amount of work that has gone in is actually stupendous. Usually you have to consider, I would say, two important things, and then there is a long list of other sort of regulatory framework that you need to consider. The first one is tax. What's the consequence of tax to make the company SPAC listable? How much is the tax triggered? Sometimes it is a dry tax that is triggered. And going forward, what is going to be the tax is another chapter by itself, because incoming shareholder, unless your structure is clean, US investors are not likely to come. They are going to look at it as a derivative instrument. So you need to be housing your company in a place where US investors are finding it friendly. Going forward, just on the income tax is this, but there are also a lot of, operational tax consideration. There is a POEM issue. There is actually an indirect tax issue. There is a service tax. Where is your company effectively, considered to be housed? Like I said, it's a very, very, very intense subject. You've got to actually answer many, many questions before you're eligible for it. Now, again, please don't take me as something that I'm scaring you away. I'm just telling you, exercise caution, go through the motion, but eventually, you can get there if you actually sort of are considerate about it. The second important criteria is RBI. Both these two Vivek touched on. So again, round tripping is an issue. Also, where is the money going to be used is going to be an issue if you're raising it from use of profits point of view. How is the money going to find its way to the operating or funding requirement in India? Is it funding the loss? Is it funding the capital asset creation? Criteria are different. And what is going to be a capital? If you are a non-capital light business, unfortunately, we are not. We had even more difficult, sort of hoops to cross. If you are just an equity funded company, technology company, knowledge-based company, it's fine. It's much more easier. But if it is actually a capital intensive business, there is a play of FDI, there is a play of ECB, there is, RBI and FEMA considerations are humongous. These two are extremely important, but there are also a host of other things. Who's going to be your directors, when it comes to governance structure? Are you ready to actually have the kind of governance structure that a US company, requires? Are you ready to have the independent audit committee? whether you are ready to prepare yourself with US GAAP or a IFRS, depending on where you're going to be housed. If you're going to be housed in US, then you have to be US GAAP. If you are outside, you can choose between US GAAP and IFRS. So, there are a host of considerations that go into listing. But the last point that I actually want to tell before moving on from this chapter is that I said in the beginning that this is not a shortcut to actually listing in US. Far from it. It's the opposite of it. The prospectus scrutiny is exactly the same that you will go through that of a US listed company. SEC reviews this document in exactly the same way. You go through the same thing. You can choose between a confidential or a public filing in the first go. SEC reviews it. There are 2 or 3 turns depending on the kind of comments that they come back with. You satisfy all their questions, and then when you are ready, they declare your prospectus effective. There is going to be no shortcut, number one. Number two, then you'll ask what's the difference between SPAC. And like I mentioned to you, from investor point of view, it's a private investment in a public company. So therefore, he gets to invest a little early as a concept to benefit from the upside by investing. So imagine you're a portfolio manager, you would like to probably put a 2 or 3% of your total portfolio into such companies, which can give you alpha return. That is number one. And number two, you have to set out projections. Now in US, if you're setting out projection, there are consequences, there are liabilities. And, no matter how much scrutiny they go through the full scrutiny, but still, you have responsibility of putting out, sort of a projection. So in some sense, SPAC. And then thirdly, the advantage is you lock the deal first because PIPE actually, is committed. SPAC is not committed until the de-SPAC process is complete. Now, if I'm going jargonistic, please tell me, ask questions. But, if the PIPE is committed, then it's, more or less a done deal. You're going to be a listed company at the end of the process as long as you fulfill the prospectus scrutiny. If you're not ready for prospectus scrutiny and if you're going to fail that process, which normally doesn't happen, then obviously you won't be. Otherwise, it's a done deal. But the counter to it is it's a long open deal. I mean, it's going to take 3 months to 6 months, more like 6 months to complete the de-SPAC process. So it's a long wait. So, like it happens in every other, sort of opportunity or product in life. This has 2 sides to the same coin. And, you've got to find the suitability of it. So, it's highly effective under a certain construct. It is highly useful, if you fulfill the requirements. And, it's a very real opportunity. And, if you're very serious about US listing, then this is actually certainly a good product because while doing this, you get the benefit of a partner coming in. Of course, he has a responsibility to diligence you, but imagine you also get the benefit of his diligence because, they actually tell you, prepare you. They are usually stalwarts in the listed company space. So they will tell you if you're not ready, they will tell you upfront they're not ready. They won't do the deal, to be honest. So, then there is also other criteria why you do a SPAC. For example, if you have more secondary in a company rather than a primary, SPAC could be more apt for you than a regular listing. So there are a few other criteria that you go through. It's obviously different for different people. So it's real. And let me actually end by saying, that once you list, you're just a listed company. After that, forget SPAC. That's just a way that you got there. After that, you're just a listed company. So you are going to, do everything that a US listed company requires, and you get all the benefits the US listed company enjoys. And that actually, let me stop there. And I think I probably ran over a couple of minutes, but over to you, Giri, and the panel.
No, that was very, very good summary in terms of process you went through and the considerations that companies should take. And clearly, it's not easy. And I guess at the end we'll probably ask you a question. Having done it, do you think you've got the benefits of this listing as compared to, say, an alternate listing? I guess that's one question which is probably worth asking somewhere towards the end, to be honest. I think I will move on to Amit from Gophers, who was kind of contemplating and has done a fair amount of work on SPACs. And over to you, Amit. Hear your perspective.
Thanks, Giri. Thanks, Madhu, for that detailed discussion. I think even after like gone for the process for like 6 7 months, I think this is a topic that you can keep on going on and on. I think there's so much learning to actually take from other people's experiences. So for us, I think we started evaluating this almost like 7 8 months back, end of last year. And one of the considerations for us outside of raising capital was also being uh, existing on a US market. I think the ecosystem for online grocery, while it's still like a nascent, few companies have been in India, but in terms of the penetration of online grocery in India, it's still is at a very small percentage of the overall retail market in India. I think in US we felt it is like the kind of analyst coverage that we could get. It made sense for us to actually go to Nasdaq and get listed, being a technology company trying to solve on a real issue of how do we distribute online grocery in India. So the process has been exciting. As Muthu said, we've had our ups and downs. We went through the entire process, right from the choice of the sponsor. I think one big learning for us was not to go choosing the sponsors yourself, but actually engage with a good set of bankers who would help lead the path in terms of negotiating the best for you. So I think one big learning was for us was like have that banker in the middle who would create a win-win proposition rather than the sponsor and the company trying to go head to head and see how. I mean, it starts like being one of and the other, but eventually I think both parties are on the same side when it comes down to getting the company listed by a SPAC. Second, I think the biggest, learning for us and amount of time spent is on the entity structure. Muthu briefly talked about it. I think we were lucky to be externalized outside India, so it was a natural choice for us being outside India. And the advantages for us from a SPAC perspective are largely, we were EGC, emerging growth company, as per the definition, within the SEC requirements, which meant that any company below a billion dollar revenues gets significant amount of exceptions in terms of their reporting, internal controls, and all of that. So I think we wanted to take advantage of that while we are still like under the threshold of revenues being set by SEC, and that was the reason we thought this is probably the time when we should go follow this path process. Eventually, I think we took a call, given the recent SEC regulatory issues and the tightening of the entire SPAC market. We did take a relook in terms of where we are, how do we want to go about it, and we said we're going to take a pause right now, see how the private equity market goes, and then continue the process of readying ourselves to be to be SPAC ready. So I think there's a process of PCOB uplift that you need to do, get your financials as per IFRS and PCOB audited. So we said we're not going to pause that process because that in itself is a big task in the entire scheme of things. So I think it's not as like a doomsday process as we talked about. I think it's a process you need to follow. There are enough advisors in the process who help you. It's a big project management task. I think be ready to lose some sleep in the entire process. I think best is to send your kids and wife to your in-laws places, because I think you're going to spend a lot of time away from home. But end of the day, I think for us it was a big learning experience in ensuring that we follow the rigor of being a listed company, even though we're not. But I think it's just an amazing process that we followed over the last like 6 7 months.
Good. Amit, thank you for that. I think one question which is coming up is really the cost of capital and one-time cost. And I think if you see, one of the things that at least I've read about is when a SPAC comes in, his own contribution is limited and he can take as much as 20% as promote as part of this whole thing. Is that what is typically seen? Is that the kind of cost that even Muthu, you alluded to 20% kind of issue cost? So and post the listing, what happens with the sponsors? How long do they stay? Do they just encash and go away? I think it's a useful question to ask because it does seem to be a very significant promote. Any of you can answer that? Yeah.
I can do it. See, first of all, promote 20% is actually a sort of a line on the sand, and conventionally you find that to be the cost. It's up for negotiation. Most people don't like to negotiate. If you're negotiating up, obviously they'll be happy. If you're negotiating down, it's going to be resistance. So therefore it depends. You do find that mostly, and that maybe going forward, actually, in my personal opinion, there is a scope for it to come down. It made sense for people to actually have 20% of a company when, imagine if they're coming in early, they're going to stay for a very long period of time. They're putting their stamp of approval, they're putting their neck out, and they have, well-accomplished professionals who actually are going to do this for next few years to come. Now it's become a bit of a conveyor belt where you finish one, go to another. So, so there is a possibility that can come down, but it's a commercial transaction. But 20% that I mentioned is the upper end. It could be 12% if you're lucky. You just have to do the maths, and banker cost is the highest, and promote cost is probably going to be the top of the list. So then there are lawyer costs, diligence costs, whole host of sort of costs that are involved. Getting your company ready, governance, board of directors, insurance. There are a lot of costs involved. So. Yeah, I think it's up for negotiation, short answer, but let's see where it goes. Right now, it is 20% most of the time.
Okay.
I have one comment to make on this. A lot has been said about promotes and how promotes are a direct cost in the company. But I think Muthu said it beautifully when he was talking. This is actually a negotiation that is across the table. I actually believe that promote is not a cost to the company, because the effective valuation that is negotiated with me is always seen net of the promote. So if I have an option to take private equity financing at X valuation, and my SPAC is at a Y valuation, I will pick up the Y valuation only if Y minus promote is greater than X. So in that sense, promote is a net of valuation cost that I should see. And therefore, cost of lawyers, cost of structure guys, cost of bankers, etc., are all genuine cash out costs. Promote to some extent is a cost that I factor in the higher valuation. Now, that may be a very different accounting type way of looking at things, but that's the way I look at it.
No, I think Vivek, you're absolutely right. That definitely, that is exactly, an answer to one of the questions in the box that I see. How do you compare with the private equity? Generally, you find what is your net valuation. Now, of course, there is one consequence to this construct, which is, once the de-SPAC is over, you are out in the ocean like any other fish. So, your value of the company is actually including the 20% dilution, whereas your earnings is what it is. Just because they are there, at least in the near term, you're not going to find actually earnings go up. And just because you came by a SPAC process, you're not going to enjoy any higher valuation.
Yeah, that's true. That's true.
To that extent, actually, there is a consequence to it. But at the time you do the transaction, you can do it with eyes open. So you can actually calculate your cost and net benefit. But eventually, the burden of servicing that comes on, let's say, you for the management.
True.
Yeah, I think over to Abhay. Abhay, I think you have also been thinking about.
Yes, thanks, Giri, and thank you for inviting me. I think we've been evaluating the Indian IPO versus the SPAC route for a while. We are an Indian headquartered company with founders who are resident in India. So looking at Vivek's 6-point checklist, clearly we start probably 2 steps behind in the race. I think I'll just try and summarize everything we heard till now. Right? I think there are the primary route or the primary reason for choosing a SPAC, I would say, is not a fundraising option, in my view. It is today the only feasible way for an Indian headquartered company to list in the US. Right? And the question of whether I should list in India or whether I should list in the US is the first question to be answered before we arrive at the route. The second question to be answered is it the right time to go public? And again, these two questions are really independent of the route you take. Once you're past these two hurdles, then the checklist starts and the questions start. I think the 4 or 5 things which we've considered and played around with are really market depth. The US market is clearly deeper, much deeper pool of capital, wider analyst coverage, presence of comparables whom your performance will be benchmarked against, and probably easier capital raising options as a follow-up. Second, the legal and compliances, we spend a ton of time on that. I won't cover it again. Tax, I think tax is very important. All your stakeholders, investors will be impacted differently, and each of them will need to closely understand what the tax implication is. Cost of listing dilution, which we discussed. And lastly, I think, SPAC or the listing is a moment in time. What happens afterwards is where, you need to prep for. So, to mention controls, governance, independence of your board, audit committee. While you may be eligible for certain relaxations in emerging growth company, the moment you cross a certain market capitalization, all of that goes away, right? So you just have to make sure that you're ready from day one and not count on those those leeways when you list. So that's something we have been evaluating as to what makes sense. Second, I would say something we spoke about briefly, but something which is really important is the quality of the sponsor. The sponsor is the person who's floated the SPAC, who's really leading the process of getting the merger done and the subsequent fundraise. The sponsor should be someone of very high repute, who's well networked, who has the ability to get capital into the SPAC in the follow-on pipe. As people mentioned, the SPAC market has cooled significantly in the last 6 months. I think that's a function of the SEC tightening some rules, some of the froth going away, and people really questioning models versus just signing up for SPACs. So it's very important that you have the right sponsor who can raise capital, is hopefully invested for the long term, and does not hopefully act just as a financial investor, but rather a partner who can work with you in the long run. I think it makes sense to keep preparing. When you're ready, you can follow that route. Some of the stuff is common. I mean, you can either if you do an India listing or a US listing, some of the prep is common, some of it is not. So sooner you make the choice, the faster you can choose the route and land at your destination. Back to you, Giri.
Good. No, I think one of the questions, thanks, Abhay. I think one of the questions which has been coming is what will happen if Gift City were to do it? I know Gift City has been doing a fair amount of work in terms of becoming a truly international financial center. And with the new head of Gift City now, the CFO board has also been making recommendations in terms of how they could make it more dynamic. I guess a question for you or Muthu or anyone else is that if such a concept had to come into India, what are 1 or 2 things that will be useful? Because, intuitively, I would imagine that for an Indian company which is considering a SPAC kind of methodology, I think if there's an Indian alternative available, it may be easier. And we have seen very crudely examples of existing shell-listed companies, people using them for reverse mergers and all that to get into a backward listing. We have seen those some examples there. But do you think, maybe Vivek, if we were to do it in India, I think what would it take for us to use Gift City to enable it actually? Or even or any of the stock exchanges, not Gift City?
See, there are 2 things that any market in this world. So Gift City is one, but we are hearing regulations come out in the UK. We are hearing regulations come out in Singapore to encourage listing of SPACs. There are 2 things that any market has to create before a SPAC can be successful there. One, of course, regulations must permit it. And therefore, this is a basic enabling feature. So when in the case of our GIFT, the government is supportive and there are enabling regulations, that's the start of the process.
Yeah.
But secondly, and more importantly, for people to list on those exchanges, there must be an environment where the deep pool of capital, as is available on NASDAQ and NYSE and those exchanges, becomes available. Abhay said it very nicely. You have to prepare for life after the transaction. So it's not just enough to do the SPAC transaction, but you have to prepare for life after it. So today I may have BlackRock and 50 other investors invest into my SPAC. But that's not enough. When they want to exit, there must be a deep pool of capital that's available. The market must understand it, and so on and so forth. Which is why even a market as sophisticated as US has taken the kind of time that it has to start firing on SPACs. And 2017, I count as the first year where SPACs really were material at a number higher than $10 billion. Yeah. So I welcome all that is happening on the IFSC gift front. I welcome all that is happening in Singapore. I welcome all that is happening in UK. But ultimately, unless these markets mature, all your urban companies and growers are going to first choose NASDAQ and then only go to these platforms.
Correct. No, thank you. Thank you. I think there are some members of the CFO board listening in. Would any one of you have any questions? We can bring them on. We can bring them onto the panel and then ask questions.
I think Sugata is there. Sugata, if you'd like to ask a question, and the team is, bringing others on board.
Yeah, hi. Hi, everyone. No, it's a big learning for me, and I was listening with keen interest. And what it seems to me is that this is something which will evolve as far as Indian companies are concerned, because with everything that has been said, uh, how is the value of this going to be seen, and how it is going to be evolving vis-a-vis the cost, not only in terms of monetary cost of 15 to 20%, which was talked about, but also the other issues that we need to look at. It seems like an interesting option for which, as Amit said, we keep our eyes and ears open and assess it very, very seriously, because this seems like an evolving space. I mean, that's what I would say, but I'm learning. Thank you.
Yeah. And just one comment actually, and I kind of look, because I think if you look at early stage investments, I think one of the concerns for investors in the early stage ecosystem is exits actually. And I think if I kind of rationalize SPACs, it seems to be a vehicle which has been set up by deep-pocketed investors to set up a vehicle ahead of acquiring an operating company, which means, so from an investor perspective, you are investing into a shell listed company, which then goes and buys an operating company. Therefore, you don't go through a gestation period in terms of an exit from an unlisted company. If I look at the way early stage ecosystem in India is developing, whether you call it a SPAC in the US or Gift City, I sometimes think that a SPAC-like concept can come in the Indian stock market, actually, because exits from early stage investment is still a big problem. Actually. Big. And therefore, if there's a bunch of investors who say, you know what, I'm ready to invest, but I don't want to take the risk of a long gestation period, it can be a fantastic enabling environment where you set up a listed company. And because these are great sponsors, it's not some irresponsible person setting up a shell company with unknown purposes. So with credible investors setting up a SPAC in the Bombay Stock Exchange and then enabling a buyout of an operating company can very well be a way in which you can take operating companies public. Actually, I don't know if any of you want to respond to that, because I am an early stage investor and I know I'm stuck, while my investments are very, very small. But I'm just thinking, is that applicable at all? You think it's a possibility in India?
No, so true, Giri. I think it's like that equilibrium that gets created by the push and the pull, so it creates pressure on the early stage companies also to scale up faster, because, the requirements of actually going public vis-a-vis keeping, companies private for a longer period of time. So I think there is enough traction on those companies also to to mature quicker. And at the same time, I think it's just the depth of the financial markets in India also, in terms of investor money, having the confidence to actually put money into the blank check companies or the shell companies to actually go and acquire, some of the operating companies. So I think I feel what you said is so relevant, is like create that push and pull within the operating companies wanting to be acquired, so they need to mature faster. And at the same time, there is capital available to buy these companies, and that ecosystem needs to be created.
Okay, no, I agree the push and pull is relevant. But Pranjal, do we want to invite others? Who else is there? I'm not able to see Angela.
There are many board members. So if any of our board members who are here would like to ask a question, Rekha, Sonal, Ajay, Hemant.
Hi, Ajay here. Thank you very much. Very, very interesting concept. And I'm very sure that, what statistics we saw for US, maybe I think for India, there should be a turnaround in the next few years. And this whole new concept that Girdhar is talking about, can we have the SPAC not as US listing, but India listing itself? I did raise few questions, I think, but Vivek was very kind to respond to them. I think for a listed company like ours, we are a listed company, no need for cash. The key question as of now will be in which situations that visibility in US really helps. So maybe a little more comments about an existing listed company, in which situations would this really help, especially if the cost is going to be 15 to 20%, there has to be very, very pressing reason.
Giri, there's also a question from Sonal. So Sonal, would you like to ask and then we can answer together?
Yeah, hello. Am I on mute? Can you hear me?
Yes.
Yeah, hi, Sonal here. Just wanted to understand the role of the sponsors, pre listing of the operating company and post listing of the operating company. What obligations are they under with respect to the SPAC as well as the SEC? And the second question I had was, what has been the track record really of this SPAC? Really, that would be the operating company, really, we should say, right? Post listing, what kind of what is that? What have we witnessed on that count?
Muthu, would you like to answer that?
Yeah, sure, I can do it. So we did do some data search on all these points. Sunil, the first question that you asked. Okay, before that, the role of sponsor. See, we saw in the very early stage, the role of a sponsor is that two independent set of companies coming together and creating, 1 + 1 is equal to more than 1 or 2 argument, which is the sponsor on the one side, and then the operating company that they merge with. And often you find SPAC, after it does the transaction, also does series of acquisitions to actually, sort of create a holistic platform. That is how long back ago SPAC started. And also, actually, things have been changed quite rapidly, as it happens in US. Very, very quick adaptations. The original SPAC sponsor would be with an industry expertise, with some track record of exposure to capital markets. So capital market would know who it is, they are backing that person. They are really wanting, that force along with the operating company force to create a much larger platform in times to come. Sponsor would have continued to work in the company for a while to come. He would have been, partnering in building this company out. But now in the last few years, we found sort of, it's much more financial than, strategic or operational partnership. And like I said, therefore things might change a little bit. The construct might change, the percentages might change. You see in the beginning that the sponsor continues with the company for 3-4 years. Today, it's like a conveyor belt, like a factory. You finish one SPAC, go to the next one from the sponsor point of view. There is a 1-year lockup, but, often today, SPAC has almost all money coming from public investors only. Very limited, sort of SPAC sponsor contributing into the, sort of SPAC also. Earlier, there would have been some skin in the game. So things are changing. Right now, like I said, it's a real product even for emerged company. In my view, the sponsor is actually in some ways a partnership. So you will look for everything that you want in a partner. I mean, something that they will contribute, to the company in reality, for building, growing, operating, making it efficient, taking it to another market, whatever be the, sort of rationale. And also, somebody who has actually, US international capital market, brand image, pre-existing brand image. These are two criteria, I would say, you will typically look for sponsor. And like I said, if you off late, it's becoming like a commodity where you just do a beauty parade. You could be talking to anybody, and then if somebody gives a more or a higher valuation, you can swing to it. These are changing times. I mean, evolving times. Now, the second question is on whether it is suitable for an already listed company. Frankly, it's a deep question. I'm not aware of any SPAC who has done it with the listed company. Now, I won't, for record, claim knowing everything about the SPAC market or studying 100% of it. But by construct, I find it difficult to, sort of see one SPAC coming together with a pre-existing listed company. And if you meant already US listed company, it's pretty difficult just to do. It is possible that you might do a simultaneous transaction of, 70-30, 60-40, 50-50, one unlisted, one listed, coming together because there is, sort of a business case to build a platform together, and one actually fits in nicely to the other, kind of an argument. I doubt actually you'll be able to do a listed company. I don't think, I'm not even talking about regulatory, I'm just talking right now about a business sense of why you would do. But, having said that, a lot of fundamental things have changed. Like I said, sponsor didn't put capital anymore. They didn't continue with the company for 5 years anymore. So, anything can happen. So you can find another, SPAC doing a listed company if it's possible.
I think we've extended time, but I think maybe Rekha, you have the one last question. There's an interest if actually, if people have time, we can extend by a couple of minutes, Giri, with your permission. But Rekha, if you'd like to ask a question.
Thanks, Pranjal. So one question I had is, we have seen quite interesting stories with some of the regulatory changes that happened in China. How are you seeing the governance around SPACs evolve to protect investor interest, right? Is there more tightening happening? What are you seeing in that space?
You want me to answer?
Yeah.
Yeah, okay. Yeah, sure. No, so actually, right around the time we announced the deal, SEC put a lot of SPACs into review, and it is a formal trackable news. So therefore, I'm not, sort of giving something which is, not in the public domain. Basically, there were a few, issues. We went through a lot of questions around projections. I told you, you might have just heard it as a word, but we lived through it. I'm telling you, it's a long process, and projection is a very, very sensitive subject. We had put out 5-year business plan, and SEC asked a lot of questions. SEC wanted a lot of clarifications. So we needed to balance out, because obviously this is not a private equity investment where we show something and say, you take your own educated risk and a guess. This is some amount of non-governing investors into the company. So that fine balance is being actually arrived at. And I saw in the chat box there are answers around warrant accounting. So that was actually changed. That also happened. That actually distorted the market, destabilized the market, exactly to the point that Vivek mentioned. In the beginning, it was shown as a debt, and later on, when actually diluted the equity, the multiple came down quite, or rather multiple went up, and EBITDA remained the same. So that actually got a big sort of things. And I also heard that SEC generally wants to tighten the regulations around it. But this is just an evolving product, right? And there is no fundamental issue here. So US has seen market tumbling and market distortions being managed very well. So I think they will put, I'm not saying it lightly, there will be evolution of this, there will be tightening of regulations, there will be change in the construct of the product, tweaks will happen. That's how actually the market works, I guess. It evolves, it changes, and things will happen. Now, are you going to be scared about it? See, that's our job, right? If we need to be cautious, but if we start only focusing on conversations around risks and problems, then we'll sort of ignore the opportunity here. So to that extent, obviously, we'll have to sort of see fundamentally, does this product suit us? If it does, then you just find solutions for the other problems.
Yeah, no, I agree. I think Pranjal, if it's okay, then I can't see any further questions from anyone. I think this has been an engaging discussion, at least in terms of building a perspective. If there are no other questions, should we just bring this session to a close? And maybe as we discussed earlier, Pranjal, Vivek. Yeah, Vivek.
I just have one thing to say. We've heard this 15 to 20% cost said a couple of times. I don't want to scare away people. When you look at a public markets IPO, there is a certain cost element involved there too. If you do a domestic IPO, the costs are pretty heavy as well. So compare it. I don't think the incremental cost in a SPAC deal is dramatic. There's a lot more brain damage that happens, but I don't think the incremental cost is something that doesn't get factored in terms of higher valuation or that the incremental cost is dramatic. So don't go away from this session thinking if you raise 500 million through a SPAC listing, you're going to have to pay 100 million of cost. It doesn't happen that way. A lot of this cost is also non-cash. So it is a genuine option to a domestic IPO. Just on cost, it can't be ruled out.
No, thank you, Vivek. I think that was a useful closing comment. Anything else from over to you, Pranjal? I'll just hand it over to you.
Thank you, Giri. And, must thank all our speakers, Muthu, Abhay, Amit, and Vivek, and Giri, to you for sharing this. I think we could go on for another hour. And as we had a pre-call, this is worth maybe 10 more hours of discussion. But the idea is to trigger thoughts and discussions. And what we will do is, if you have more ideas, please reach out to us at our website and our email, secretariat@cfoboard.com. And we can plan some more discussions around this theme. Once again, thank you for joining us and for sparing your time. Bye.
Thank you. Bye-bye.